Welcome back to Helper Dad. Today, we're diving into Dividend Aristocrats and exploring whether you should consider investing in them. We'll start by understanding what exactly Dividend Aristocrats are. These are companies within the S&P 500 that have consistently increased their dividends for at least 25 consecutive years and meet specific market capitalization and liquidity requirements. We'll also touch on dividend investing generally, before diving into a comprehensive look at the pros and cons of focusing on these aristocrats. Oh, what criteria must a company meet to earn the title of Dividend Aristocrat? First, they must be part of the S&P 500. Second, they need that impressive track record of increasing their dividend payout for at least 25 years in a row. Additionally, they need to meet minimum market capitalization and average daily trading volume thresholds. These criteria are significant because they indicate a company's financial stability, its dedication to rewarding shareholders, and its ongoing relevance in the market. Keep in mind that the list of Dividend Aristocrats isn't static. There's an annual review process, and if a company fails to meet the criteria, it's removed from the index. ETs talk about the advantages of investing in these dividend dynamos. One of the biggest benefits is the consistent income stream they provide, reliable and growing dividends. You can even reinvest those dividends through a dividend reinvestment plan, or DRIP, to buy more shares. Historically, Dividend Aristocrats have also shown lower volatility compared to the broader market, tending to hold up better during market downturns. These are generally established, mature companies with proven business models, offering long-term growth potential. And, importantly, those dividend increases can act as an inflation hedge, helping your income keep pace with rising costs, while reinvested dividends help generate compounding returns. Of course, there are potential drawbacks. Because these are typically mature companies, their growth potential might be slower compared to younger, high-growth stocks. Also, their popularity can lead to overvaluation, and there's always the risk of a dividend cut if a company's financials take a turn for the worse. It's also worth noting that the index might be concentrated in certain sectors, which can reduce diversification. While the focus is on dividend consistency, the actual dividend yield might not be particularly high, which might not suit investors looking for immediate, high income. Remember, past performance is no guarantee of future results, and changing economic conditions can impact these companies just like any other investment. Oh, how do you actually invest in Dividend Aristocrats? You have a few options. You can buy individual stocks directly, but that requires research and active portfolio management. A simpler way is through exchange-traded funds, or ETFs, that track the S&P 500 Dividend Aristocrats Index, funds like NOBL. These offer instant diversification and typically have lower expense ratios. Mutual funds that focus on dividends may also hold Dividend Aristocrats, but often come with higher expense ratios than ETFs. Regardless of how you choose to invest, consider using a dividend reinvestment plan to automatically reinvest those dividends and buy more shares. Now, let's consider some alternatives. High-yield dividend stocks might offer higher current income, but come with potentially higher risk. You could also look at broad market ETFs for diversification across the entire market. Growth stocks offer higher growth potential, but are generally more volatile. And finally, real estate investment trusts, or REITs, often provide high dividend yields. In conclusion, Dividend Aristocrats offer a blend of income, stability, and long-term growth potential, but they're not without their risks and drawbacks. Whether they're right for you depends on your individual investment goals and risk tolerance. Consider them as a possible component of a well-diversified portfolio. Always do your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching. See you next time on Helper Dad.